The deck page is a snapshot of your policy. It should be read alongside the full policy, forms, and endorsements. The deck page is not your full contract. Welcome back, I'm the insurance lady, and today I'm going to show you how to read a deck page because it can be confusing if you're not sure what to look for. You might be wondering why it's so important to read your deck page as soon as you get it. And a good scenario to explain this concept would be whenever you are requesting insurance from your agent, let's say they're going to submit an application on your behalf, and you've requested the HO3 form, but what you get could be something different from what you asked for. In the sense that when your agent sends off that application, the coverage that's bound could be that HO3, but there could have been other forms that were added based on underwriting restrictions. An example would be if the carrier that you're requesting coverage from has a rule where all roofs that are 25 years or older needs to have a roof exclusion on the policy. That roof exclusion wouldn't have been included in the quote that your agent sent because obviously you're not going to be asking for that, but it could have been added to the policy that you received. And how do you know if that was added? You check your deck page. So today we're going to have a look at one of my old deck pages. I've modified it so it's got all the generic information that we need.
Okay, so diving right in, here's a sample deck page, and they might look different to the deck page that you have, but they'll all have the same information on them, but different insurance carriers do format them a little bit differently. So if yours doesn't look exactly like this, that's okay. This is just an example of what it could look like, but it will have the same information that your deck page should have. So we'll start at the top, and the top usually is where you'll find your insurance company's name listed. So it could be Nationwide or Allstate or State Farm. It'll tell you who's actually issuing the policy. And then this right here is somewhat unique. So this particular deck page does list the form at the top, but not all of them list it at the top. You'll be able to find it in another spot, which we'll touch on, but I do like it whenever they have them listed at the top because you can kind of easily reference which policy form you have. But if yours doesn't list the form at the top, don't worry because there's still another section where you can figure out what policy you have. And then you've got the policy number, which is listed right here. And you can see that the policy period is effective from June 3rd, 2026 to June 3rd, 2027. Typically, the policies are going to have a 12-month period, but sometimes you can find policies that have 3 months or 6 months or 9 months. It really just depends on the type of policy you're getting it. Also, how long you're getting it for, how long you need it for. A lot of times with commercial policies, we'll see a 6-month policy period, but typically homeowners and renters insurance does have a 12-month policy period as pretty standard. The policy will also list, or this deck page will also list who the named insured is. So you can see here that the named insured is John Doe, and the mailing address is listed below, which is right here. You can see that the insured location is also mentioned separately, and this is because sometimes someone may have a different mailing address from where the property is that's insured. An example would be if you've got a P.O. box that you choose to get all of your mail delivered to, or if you have a rental property, then sometimes your mailing address would be different than the actual insured location because the insured location you use as a rental and it's not your primary place to receive your mail. Your insurance agency will also be listed. It'll have their address and their contact information. You might see that there's an agent code listed, but you don't need to worry about that. The next section is your coverages. So this is going to give you a snapshot of what coverages are afforded to you under the policy. So you can see that dwelling is listed along with other structures, personal property off premises, and loss of use. And it has the corresponding limit of liability with each coverage. So this will tell you that your policy provides coverage for your dwelling up to $200,000, and then your other structures is up to $20,000. And other structures is any structure that's detached from the dwelling, typically like a fence, or if it's a shed or, freestanding garage. So if you have a garage that's attached to your house, that's considered part of the dwelling. But if your garage is a detached garage, then that would classify as other structures, and you would want to make sure that you have coverage for that, because not all policies automatically come with other structures coverage. So you want to make sure that if you have something that would apply to other structures, you do have that. You can see that personal property is broken out into two different coverage types. You've got personal property and personal property off premises. You can see the limits are significantly different. And personal property off premises is the limit of liability whenever you have a loss to your personal property, whenever it's away from the insured premises. In this case, the insured location is 123 Main Street. So if you have personal property in your vehicle and you're driving around away from your insured location and your car gets broken into and they steal your items, then that personal property that was in your vehicle would be covered under your homeowner's policy under the personal property off premises coverage. And then there's also loss of use. Loss of use could be interpreted a couple different ways. There is additional living expenses, and then there's fair rental value. Fair rental value is whenever you lose your rental income because of a covered loss. An example would be if a hurricane came through and damaged your rental property and your tenants had to move out, or let's say you have an Airbnb and you are unable to rent it during the repair process, then you would be able to request your loss of use for the fair rental value, and that would be subject to its policy limit and coverages. And additional living expenses is the increased cost of living due to you being placed from your home during the repair process. An example for this would be if a hurricane comes through and damages your home and you have to stay in a hotel during the repair process because the bathrooms and the kitchen are all destroyed and need to be completely repaired, then that would be an example of when you would be able to submit your documentation and request additional living expenses under your loss of use coverage. And then we've got the Section 2 coverages, which is the liability section of your policy. This section covers personal liability and medical payments. These are two separate coverages. You can see with significantly different limits. Personal liability has $100,000 and the medical payments to others has $1,000. You can see just to the right of this, I've actually X'd this out, but this is where you would see the amount that you're paying in your premium for each of these things, and it would be calculated down here as well, and that's how you can see what you're paying for your total premium. This Dec page also will tell you what your deductible is. So in this instance, it has two different deductibles. The first is the other covered perils, which is 1% and a minimum of $1,000. And the second is the windstorm or hail deductible with a 2% and a minimum of $2,000. The way that these percentage deductibles are calculated is based on your dwelling limit. So you would take 0.01 and you would times that by 200,000, and that would get you 2,000, which is your 1% minimum, which is your 1% deductible. If your policy limits are, let's say, 79,000 for the dwelling, then 1% of that would actually only be 790, which falls below the minimum of 1,000. So that would mean that your other covered perils would be 1,000, not 790, because it does have a minimum of 1,000. And the same goes for the windstorm or hail deductible. So the 2%, you would be able to just take 0.02 times it by your policy limit, which is 200,000 for the dwelling, and then that would get you 4,000. So that's your windstorm or hail deductible. It's $4,000, and you can see that it exceeds the minimum threshold of 2,000. So it would just be the 2%, which is 4,000. Just below that, you can see that this is the section where it would show you who's issuing the policy. So it would either be your carrier or a representative who has authority to write business on their behalf, such as a cover holder. And then below is where you'll find your mortgages. So sometimes there's one mortgage, sometimes there's more than one, there could be two or three, and sometimes there's no mortgages. So you want to make sure that you reference this field and make sure that if you do have a mortgage, it is listed and it's listed accurately. And any changes to your mortgagee should be reported to your agent as soon as they're made. It is contractually required for you to report any mortgage ease on your policy, so you'll want to make sure that that's an accurate representation of any lien holders for the property. Another item that I wanted to discuss is the named insured. It's important that the named insured matches the ownership that's on the deed for the insured location. And the reason is because when you file a claim, your carrier is going to have to confirm what's called insurable interest. And that means that you essentially have the legal right to pull an insurance policy on a particular property. You wouldn't be able to file an insurance policy or, request an insurance policy on your neighbor's house because you don't own your neighbor's house. And so, in order to confirm this insurable interest, your carrier is going to have a look to see who actually owns the property. And if, let's say, John Doe, he owns the property, but actually the property is in a trust's name and he just happens to be the person who manages the trust, even though he's the manager of the trust, it would still actually need to be placed in the trust's name. So whatever this named insured is right here, it has to be the legal owner of the property. So if you see that maybe your policy has been issued in a different name and you thought that maybe because you're an executor or a manager of the company that the property is owned in, that it's okay, you need to contact your agent and let them know, hey, actually this property is owned by my LLC, and so the LLC should be the named insured. And you will still be considered a named insured under the policy, but the named insured that's listed on the Dec page does have to match the legal owner based on the deed. Moving on to the next page, you'll see the policy number is referenced again up here. Any credits that you may be receiving will also be listed here, and it'll show it as a negative number to show that you're getting a credit or, something of that nature that's affecting your premium. Then we have the underwriting section. This just basically describes the property. So you can see based on this description that this particular home is a 1,529 square foot house that's built in the year 2000. And it has a brick veneer exterior, and the roof material is composition, which means that it's a shingled roof, and the occupancy is set to owner primary. This is important because when this policy was first issued, it was issued as an owner primary policy, and let's say later down the road, John Doe decides to buy a second property, and he makes that his primary dwelling, and this particular property now becomes a secondary dwelling. He would need to notify his agent of any changes in occupancy because that could affect coverage and it also could affect your premium. So you want to make sure that you're disclosing any of those occupancy changes right away so that your agent can go ahead and take care of that for you, because if you don't and then you have to file a claim, it could create issues for you and delays if it's discovered later that you never actually notified your agent of the occupancy change. And depending on the circumstances, it could end up voiding your policy. So do make sure that you're transparent with your agent about the occupancy and any changes in the occupancy moving forward. So now let's get into the fun bit. When you think of a Dec page, you should view it as the index of a book. So when you're reading a book and you see the index, it lists all the chapters so you know exactly everything that's entailed within that book. Same thing for the Dec page. You can see there's a bunch of forms and endorsements that are listed. This is the index of the policy that's been specifically issued to you. You can see, for example, this first one that's listed says declaration page or Dec page, and you can see that next to it the form number says HODEC 1018, and if you notice at the bottom right hand corner, that same form number is listed here. So you can see that this particular document that you're looking at is the HODEC 1018, and you can match that up here with the form number and look over to see the description and see, yep, it's the Dec page that I'm looking at. This is a great tool if you're going through your policy and you see a form that maybe you're not familiar with. You can always confirm not only by the name, but by the form number. Something to know about the form numbers is that you can have multiple form numbers that are the same, but the addition is different. So an example would be right here. This is what I was mentioning earlier, where it would later show you what form of policy you have. So this is where I would look down and find, oh, I've got an HO3 special form. And that can tell you a lot in and of itself. This tells me that I have an open perils policy for the dwelling, and it tells me that I have a named peril policy for my personal property. That's a standard HO3 ISO form. And as I mentioned before, an HO3, which is notated right here, the HO and then 0003, that's your form. And then the 511 is addition. So I could have an HO3 and my sister could have an HO3, but they could have slightly different wording in it, and you'd be able to tell based on the addition. So if mine says 511 and hers says something different, like maybe 713, then that would mean that there might be a few words that are slightly different between our policies. So even though you've had an HO3 in the past, if you see that you have an HO3 here, you would still want to make sure to take a look on it just to make sure that nothing has changed between the additions. Even though they're substantially the same, a few of the wording pieces could have changed. Another important endorsement to have a look at is one that's called special provisions. This one can vary based on state, and so they're not exactly the same, but what this means is it's an endorsement that changes the policy wording and changes some of the coverages, and usually it'll differ by state. So all the Texas state provisions with the HO 142, 212 will all be this 217, sorry, they'll all be the same. And, we handle claims in North Carolina, so sometimes it'll be the North Carolina special provisions. That'll be completely different from the one that's issued in Texas. Now you can see that I'm not touching on every single one of these. I'm going to point out some of the important ones to look for straight out the gate. A lot of these others are pretty standard, and they're not necessarily what we're focused on today. So moving along, this is a pretty big one. So this one has actual cash value loss settlement. You can find that right here. And what that tells me is when you see loss settlement in here, that is going to refer to how claims are settled. And what I mean by that is how claims are paid. So if you see loss settlement, think loss payment. So this endorsement is titled Actual Cash Value Loss Settlement. So this tells me that I've probably got an endorsement in the policy that's saying that my claims are going to be paid at actual cash value, which means depreciation will be withheld and it won't be able to be recovered. So you'll want to take a look at this one and see exactly what the wording is to see how it affects your policy and claims that you may have in the future. This next one applies to your roof. It's called the Limited Loss Settlement for Losses to Roof Surfacing. I've seen this one listed a few different ways in policies. In Allstate, it's referred to as a roof surfaces endorsement. And what these endorsements mean is it's got a pre-agreed percentage of what the insurance company will pay for damages to your roof dependent on the age. So for example, if you have a 10-year-old roof that is made up of shingles as the roof surfacing, then the carrier would say probably only pay 75% of the value of the roof. And that is regardless if you get it repaired or replaced or not. So these are for roof replacements, and you can still get the payment up front. And sometimes with other policies, you may have seen that if you replace your roof, you can submit your documentation and apply for the recoverable depreciation, which means that at the end of the day, you will have been paid for your roof in full, except for your out-of-pocket policy deductible. And when you see endorsements like this is specifically saying that not only will you not get a depreciation amount that's recoverable to you, but it's going to be a pre-agreed percentage. So instead of the adjuster trying to determine the age and condition of the roof to establish how much your roof is depreciated, this form pre-agrees it between you and the carrier. So this will tell you how much percentage you're going to get for your roof for roof replacements due to a covered loss based on its age, and then there will be different rows based on your roof surfacing type. So it'll be, composition, which is shingle, metal, that sort of a thing. The next one is microorganism exclusion, and this is important. It's also referred to as a mold exclusion. So this is going to exclude any damage from mold regardless of the cause. So if you have, a water leak and mold ends up forming on your walls, that's going to be excluded even if that water leak was covered. So this specifically excludes any mold damage. The next one is the neglect exclusion. And this is an important one to read as well, because this one is going to discuss the exclusion that would be in place if an insured fails to protect their property from further damage. So that would be considered neglect. So if a policyholder fails to protect their property from further damage and it allows it to worsen, that's viewed as neglect. And then as a result, those damages wouldn't be covered if they were the result of neglect. This occupancy endorsement is going to discuss, obviously, occupancy. So you'll want to take a look at that because I have seen some of them vary in the language that they use, and it's basically going to set out some parameters about some maybe rules or limitations that would apply dependent on the occupancy status of your home. So be sure to take a look at that because that one is important and a lot of people do overlook it. This percentage deductible calculation endorsement is going to just basically outline the same thing we discussed earlier about the percentage deductibles. It just puts it in an endorsement so that you can see how it's calculated. And the next one is personal property replacement cost loss settlement. As we mentioned before, anytime you see this, think it's, you should replace it in your mind with maybe lost payment. So okay, this is going to refer to how my claims are paid and more specifically, personal property replacement cost. So this particular one is going to give me replacement cost coverage on my personal property. And that means that depreciation would be recoverable as long as the items are replaced with like, kind, and quality. And it's based on the amount actually spent. Pre-existing damage endorsement. This one is going to essentially say that any damage that is present prior to the policy's inception date is considered pre-existing in nature and therefore would be excluded because this policy only provides coverage for damages that occur within the policy period. There's another occupancy endorsement here. It's called the vacancy unoccupancy condition. And this is going to give you additional conditions that could limit coverage or the limited liability for your coverages, depending on if certain conditions are met pertaining to the vacancy and unoccupancy. Language is really important in these particular endorsements, so be sure that you read it, and it could lay out some specific rules, such as if you're away from your dwelling for 60 days, then that would be considered unoccupied or vacant, and then there would be no coverage for any loss, something like that. So you do want to make sure that you read those because those could substantially change your policy's coverage in certain scenarios and situations. The next is the water backup and sump charge or sump discharge or overflow. This one is setting a sublimit of $25,000. So even though your dwelling has a policy limit of $200,000, what we saw earlier, This particular endorsement says that if there's any covered loss that's a result of water backup or a sump discharge or an overflow, that limit is going to be set at $25,000 and you won't be able to recover anything over that set amount. Again, we've got the windstorm or hail percentage deductible. As I mentioned before, this endorsement just discusses what we already spoke about above. It just outlines it and explains how that is calculated and tells you what that percentage deductible is. The next one is the animal exclusion, and I've seen different versions of animal exclusion, so you should certainly read it. They can say anything from certain animals are excluded based on their breed or if they've had a bite history, but they could also just be a blanket animal exclusion saying that no damage or bodily injury is covered if it results from any animal, whether or not owned by the insured. So have a look and see which type of animal exclusion you have so that you're well aware of that. And you can see that there are other ones that could apply to you, such as a swimming pool or trampoline. If you see one listed that you might think could apply to your situation, then take note of it, make sure you're reading it. And if there's anything that comes up that you're concerned about, reach out to your agent to try to get your options in making changes. And that concludes the Dec Page tutorial. So as you can see, the Dec Page shows you a lot of information and is a really great starting point and can tell you a lot about what coverages you have, but it's not a substitute for reading your actual policy. So be sure to check out the particular policy language, see what's covered in this H03 special form, and see what general exclusions could apply.
As you can see, the Dec Page can tell you a lot of information. Who is insured, what property is insured, what coverages are afforded to you under the policy, and what those limitations are. It also can tell you what your policy deductibles are, and it can list all the different forms and endorsements that could affect your policy coverage. Use the Dec Page as your roadmap. Remember that it's not your entire policy. Use it to orient yourself, and then read your full policy and all the forms and endorsements. If you found this video useful, be sure to like and subscribe. If you found this video useful, be sure and like and subscribe. And if you have any insurance or policy questions, or there's a particular insurance topic you'd like me to cover, be sure to leave that in the comments, and then I can create a video answering any questions that you may have. I'll see you next week as I continue to help you get the most out of your insurance policy.